Good afternoon, everyone. Thank you for joining us today. My name is Lamar Barton. Today's training has been designed to give you a basic understanding of sensitivity analysis and its use as a tool for capital budgeting. The presentation aims to help you to understand how companies incorporate risk into their capital budgeting decision by both using quantitative and qualitative measures. By the end of the session, you will know about the objectives of financial management, the process of sensitivity analysis, and how internal and external risk factors affect investment decisions. Now let's take a look at the goals and function of financial management. All aspects of financial management are directed towards maximizing a firm's value. Ross, Westerfield, and Jordan state that one can accomplish maximization of a firm through the efficient allocation of capital, the balancing of risk and return, and the long-term sustainability of the firm. Financial managers determine which projects to fund, how to finance them, and how to manage the financial risk. Capital budgeting is a key element of these decisions. A firm's long-term investment decisions have a lasting impact on its value. This brings us to our next point, capital budgeting and the role of risk. The evaluation of long-term investment projects through capital budgeting include, but is not limited to, the purchase of equipment, expansion of business operations, or the addition of new technology. Cornett, Adair, and Nofsinger explain that capital budgeting typically have high uncertainty and irreversibility, meaning that once capital is committed, it is expensive and generally impractical to reverse that initial investment decision. The cash flow relates to the future are based solely on forecasting. Thus, it is necessary to closely examine the risk of capital deployment and incorporate it into decision-making process. But what is sensitivity analysis? Sensitivity analysis is a technique that determines the financial implications of shifting key project assumptions. According to Suresh, sensitivity analysis is a procedure that isolates individual variables and identifies the assumptions that most influence a project's ability to remain viable. With sensitivity analysis, managers can identify the primary key factors affecting their company's flexible budgeting decision and provide increased confidence in their capital budgeting decisions by pinpointing the areas where their estimates are most reliable. The quantitative process of sensitive analysis begins with identifying key financial variables such as sales volume, sales price, operating costs, and discount rate. Each variable is adjusted one at a time, while all other assumptions remain constant. The project's net present value or internal rate of return is then calculated. Ross and his colleagues emphasize that this process allows managers to clearly see which variable creates the most financial risk. This brings us to our next point of qualitative factors affecting project risk. Not all risk can be measured numerically. Qualitative factors play an important role in capital budgeting decisions. Machika highlights such factors as market volatility, management capability, regulatory environment, and competitive pressure as key influence on project success. These factors provide essential context to qualitative results and help decision makers avoid relying solely on financial models. Now we will transition into the internal methods for integrating risk. Organizations use several approaches to integrate risk into their internal capital budgeting. The following approaches are commonly employed: scenario analysis, break-even analysis, and risk adjustment discount rate. According to Coronet Research, scenario analysis examines the best and worst case scenarios, while break-even analysis establishes a minimum performance level. Management judgment in interpreting these results and aligning these projects with strategic goals is essential. Now let's look at external methods for integrating risk. External risk integration includes aspects that an organization cannot manage or control. They include items such as industry benchmark, market risk premium, economic indicators, and interest rate trends. According to Ross, capital budgeting considerations should include wider market considerations to represent realistic risk assessment. External data is used to evaluate projects in light of general economic conditions. In conclusion, sensitivity analysis is a vital tool for integrating risk into the capital budgeting decision. It allows financial managers to identify critical assumptions, understand financial exposures, and combine quantitative analysis with qualitative judgment. When supported by internal evaluation methods and external market data, sensitivity analysis improves decision-making quality and supports long-term value creation. My name is Lamar Barton, and thank you for listening.